China dumping U.S. stocks and bonds? The financial relationship between the United States and China is one of the most influential and precarious relationships in the global economy. One of the key areas where this relationship plays out is in the holdings of U.S. assets by the Chinese government and institutions, particularly U.S. Treasury bonds and equities. Recently, speculation has intensified around whether China is actively reducing or dumping its holdings of U.S. stocks and bonds. This article explores the facts, motivations, economic implications, and long term consequences of such a move. Section 1. What does dumping U.S. assets mean? In financial terms, dumping refers to a large and often abrupt sell off of a particular asset. When it comes to China, the two primary U.S. assets in question are 1. U.S. Treasury bonds, government debt. 2. U.S. equities, stocks. If China were to significantly sell off these holdings, it could drive up U.S. bond yields, interest rates, pressure the U.S. dollar, cause turmoil in U.S. stock markets. But is China really doing that? Let's look at the data. Section 2. China's holdings of U.S. Treasuries, the downward trend. As of 2024, China holds around $775 billion in U.S. Treasury securities, down from over $1.3 trillion in 2013. This is a 40% decline over a decade, and the trend appears to be continuing into 2025. Key data points. Peak holdings, 2013, $1.3 trillion. Holdings, 2024, $775. Monthly sell-offs, $10 to $15 billion on average. Who surpassed China? Japan is now the largest foreign holder of U.S. Treasuries. Interpretation. China isn't suddenly dumping treasuries, but there's a clear, sustained divestment strategy. This move appears deliberate, systematic, and long-term. Section 3. China's U.S. stock holdings. Unlike U.S. Treasuries, data on Chinese ownership of U.S. stocks is less transparent. However, according to filings with the U.S. Securities and Exchange Commission, SEC, China's direct ownership of U.S. equities, including via sovereign wealth funds and state-run firms, has also decreased in recent years. In 2020, Chinese entities held around $211 billion in U.S. equities. By late 2024, this had reportedly fallen below $150 billion. While not as dramatic as the Treasury sell-off, this indicates a broader shift away from American financial markets. Section 4. Why is China reducing its holdings? 1. Geopolitical tensions. China-U.S. relations have worsened due to Taiwan tensions, trade wars, technology sanctions, e.g. chips, Huawei, TikTok bans, semiconductors and AI restrictions. China may fear asset freezes or sanctions, especially after the U.S. froze Russian reserves in response to the Ukraine invasion. China's strategy, de-risking from U.S. exposure in case of future conflict. 2. De-dollarization. China is promoting the yuan, RMB, as an alternative reserve currency. It has signed yuan settlement deals with countries like Russia, Brazil, and Saudi Arabia, increased gold purchases massively since 2023, encouraged Belt and Road partners to trade in local currencies. Reducing U.S. holdings supports long-term de-dollarization goals. Hash 3. Diversification. China is reallocating assets into gold. Central bank now holds over 2,500 tons. Commodities like oil, copper, lithium. Other currencies, euro, yen, Swiss franc. Asian and global South markets. This helps reduce risk from U.S. financial system volatility. 4. Domestic economic pressures. China is facing a real estate crisis, Evergrande, Country Garden, weak consumer demand, youth unemployment above 15%, local government debt problems. It may be liquidating U.S. assets to shore up its economy or support the yuan during currency pressure. Section 5. Impact on U.S. economy and markets. If China were to rapidly sell off U.S. treasuries or stocks, it could spark 1. Bond market shock. Prices drop, yields spike. U.S. government borrowing costs increase, could lead to a debt spiral, inflation, or recession. 2. Stock market turbulence. Could signal loss of confidence in U.S. markets, may trigger sell-offs by other countries or institutions. 3. Dollar volatility. Sudden selling weakens the dollar. Could trigger inflation in the U.S. as imports get expensive. But so far, the sell-off has been gradual, preventing panic. The U.S. Treasury market is also deep and liquid, so moderate outflows are absorbed. Section 6. Can China really hurt the U.S. by dumping assets? In theory, yes. If China sold off all $775 billion in treasuries at once, it would crash bond prices, raise U.S. interest rates sharply, shake investor confidence. In practice, unlikely. China would also hurt itself, lower value for its remaining U.S. holdings, strengthen the yuan, hurting Chinese exports, destabilize global markets, which China depends on. Hence, China is divesting slowly to avoid economic self-damage. Section 7. What is the U.S. doing in response? The U.S. is encouraging domestic buyers, banks, Fed, pensions, to absorb treasuries, relying more on Japan, the U.K., and investment funds, keeping interest rates high to maintain dollar strength and attract capital. But there's concern over long-term sustainability of U.S. debt financing if foreign buyers retreat. Section 8. What are other countries doing? China is not alone. Countries like Russia, Brazil, Turkey, Saudi Arabia, and even some European nations are reducing dollar reserves, buying gold and yuan, trading in non-dollar currencies. This trend, called de-dollarization, could reshape global finance over the next decade. Section 9. Could this lead to a financial crisis? Possibility. Low in short term. The U.S. still has the world's most trusted legal system, owns the global reserve currency, hosts the largest and deepest capital markets. Risk? Rising in long term if China escalates divestment, other countries follow rapidly, U.S. political gridlock continues. Then the U.S. could face a bond crisis or currency weakening, triggering broader financial shocks. Section 10. Expert opinions. JP Morgan 24. China is systematically reducing its U.S. bond exposure, not in panic, but as a matter of long-term policy. Ray Dalio, Bridgewater Associates. The decline of dollar dominance is slow but real. China is preparing for a world with multiple financial centers. U.S. Treasury Department. We are monitoring global flows. The strength of the U.S. economy and the dollar remains robust. Conclusion. So is China dumping U.S. stocks and bonds? Yes, gradually. China is clearly reducing its exposure to U.S. financial markets as part of a long-term strategic shift. But not recklessly. China is aware that crashing the U.S. market would hurt itself and destabilize the global economy. What it means for investors. Watch for changes in bond yields and foreign ownership data. Monitor gold prices and yuan trade deals. Keep an eye on geopolitical developments like Taiwan and BRICS expansion. The U.S.-China financial decoupling may be slow burning, but its long-term consequences could be profound for investors, economies, and the balance of global power.